$100. Most people spend that on a weekend and don't think twice about it. But that same $100 put in the right place today could be worth over $1,700 30 years from now, without you doing anything else. Here's exactly what to do with it. If you've been putting off investing because you thought you needed more money to start, this video is going to change that. We're going to walk through the entire process, step by step, using just $100 as your starting point. No jargon, no complicated strategies, just a clear, honest answer to the question, where does this money actually go? Just a quick note before we dive in. Everything in this video is for educational purposes only. Nothing here is financial advice. Always do your own research before making any financial decisions. Now, let's talk about what actually happens when you decide to invest. What is a brokerage account and why you need one? Before your $100 can do anything useful, it needs a home, and that home is called a brokerage account. Think of it like this. A regular bank account holds your cash. A brokerage account holds your cash and lets you use it to buy investments, like stocks, ETFs, and index funds. Opening one is free and takes about 5 minutes. You don't need a financial advisor. You don't need a suit. You just need your phone and some ID. If you're in Canada, Wealthsimple is one of the most beginner-friendly options out there. There's no minimum deposit, meaning you can start with exactly $100 or even less. You open the account, transfer your money in, and you're ready to invest. The link to open a free Wealthsimple account is in the description below. It takes about 5 minutes and there are no fees to open. So now your $100 is sitting inside your brokerage account. The next question is the one everyone gets stuck on. What do you actually buy? What to buy with your $100? Here's where most beginners make their first mistake. They try to pick individual stocks. They buy one company because they've heard the name before. And while that occasionally works, it's a bit like betting your $100 on a single horse, instead of owning a small piece of every horse in the race. The smarter approach for beginners is something called an index fund, and specifically, a type of index fund called an ETF, which stands for Exchange Traded Fund. Here's what that means in plain English. An ETF is a single investment that holds hundreds, sometimes thousands, of companies at once. When you buy one share of a broad market ETF, you instantly own a tiny slice of the entire economy. For example, a fund like XEQT, a popular Canadian all-in-one ETF, holds over 9,000 companies across the globe in a single purchase. One share costs roughly $25 to $30 at the time of recording. So your $100 could buy 3 or 4 shares and immediately spread your money across thousands of businesses worldwide. When those companies grow, and historically, over the long run, they do, your investment grows with them. You're not betting on one company. You're betting on the global economy. That's a very different risk level. And that habit of buying consistently is actually the most powerful thing you can do. Which brings us to Chapter 3, the habit that separates investors from everyone else. Here's the truth. Investing $100 once is not really the strategy. The strategy is investing $100 every single month consistently, whether the market is up or down. This is called dollar cost averaging, and it's one of the most powerful concepts in personal finance. The simple timeline: when the most up, your $100 buys fewer shares. When the market dips, your $100 buys more shares at a lower price. Over time, this averages out your cost and actually benefits from market volatility instead of suffering from it. And here's what the numbers look like in practice. If you invest $100 every month into a broad index ETF that returns an average of 7% per year, which is roughly the historical average, after 30 years, you'd have invested $36,000 of your own money. But the actual value of your portfolio? Just over $121,000. You're discovered by this mini fact prevented $85,000 didn't come from working harder. It came from starting, staying consistent, and letting compound growth do its job. Now, I know what you might be thinking. What if the market crashes right after I invest? It's a fair question, and the honest answer is, it probably will at some point. Markets go up and down. But every single major crash in history has eventually recovered and gone higher. The people who lost money were the ones who panicked and sold. The people who stayed patient came out ahead. Your job isn't to time the market. Your job is to stay in it. Let's bring it all together. 3 things to remember from this video. Open a free brokerage account. Wealthsimple is a great starting point in Canada. Buy a broad market ETF instead of individual stocks. It spreads your risk instantly. Set up a monthly recurring investment and don't touch it. Consistency beats timing every time. Now that you know where to put your money, the next question is, what exactly is an ETF? And how do you know which one to pick? I break that down completely in my next video, and I keep it just as simple as this one. It's linked right here. I'll see you there. Disclaimer: this video is for educational purposes only and is not financial advice. Always conduct your own research before making investment decisions.